How to Trade Forex Lecture 7, and in this lecture we're going to look at spread betting and specifically what is the difference between spread betting, contracts for difference and other types of currency trading. We'll also be looking at the practical issue of opening and closing trades, and we'll be finding out what bid and ask prices actually are. Spread betting. A lot of people from around the world are not involved in spread betting. We in the UK tend to like it for tax reasons. Spread betting is a form of betting, and in the UK that happens to be the case that for most people, under most circumstances, it doesn't involve paying any tax on the gains that you make. However, all we're actually doing really is placing a bet. We call it a trade, and we're saying we think that the price of the pound dollar is going to rise, and therefore we're going to bet that it's going to rise, and that bet will be based on an amount. So, for example, £1 per pip, or £2 per pip, 10 pence per pip, whatever it might be. And if it goes up, we'll make money at that rate. If it goes down, we would lose money at that rate. But, in essence, that's exactly the same as buying some of the currency or selling some of the currency. So if we were to buy some of the currency, its value would change at the same rate, up or down, depending on how much we'd actually bought of it. So they're very similar. The charts look exactly the same. The candlesticks look exactly the same. There are very few differences. But if you're in the UK or another area where the tax laws are friendly towards betting, then it's something that you should consider taking advice on and possibly therefore taking up. In basic terms, forex trading involves predicting exchange rate movements between a pair of currencies and then buying or selling, that's trading those currencies, in set amounts which are called lots. A lot is a multiple of the currency being traded, or parts of a lot, and then taking profit on the movement between them if the prediction is correct, and a loss if the prediction is incorrect. Spread betting involves predicting exchange rate movements between a pair of currencies and then placing a bet on the direction that the exchange rate will move in. The bet placed takes the form of an amount per point. If the predicted direction is correct, the bet is won. If not, then it is lost. Spread betting under most circumstances in the UK does not attract any form of tax. We're not aware of anyone having been made to pay tax on spread betting winnings, again, in the UK. And anyone who is in any way unsure about their own tax position should take professional advice before spread betting or trading or speculating on foreign exchange markets. Apart from the tax advantages, for me, here in the UK, I prefer spread betting. Spread betting is just easier to understand. We can see just what a trader is making or losing for every pip of movement, without having to worry about how much a lot is worth or what a part of a lot or whether on mini lots, etc. So I really would say either use spread betting or use something as close to it as you can get by the trading platform that you're using. The forex market seems to agree with me, and it's now moving to CFDs. CFDs are contracts for difference, and CFDs, or contracts for difference, work in exactly the same way as spread betting, but without the tax advantage. Therefore, if you're going to use the GKFX trading platform, which I thoroughly recommend that you do, and you're not in the UK, then you should use the CFD option. If you are in the UK, under most circumstances for most people, you should choose the spread betting option. The difference in the UK is, if you choose CFDs and make a profit, then that profit could be liable for tax, whereas spread betting it probably would not be. So let's have a look now at buy and sell trades. What do we mean by these terms? In spread betting, a buy trade, and this applies equally to CFDs, a buy trade is simply a bet that the price on a chart that you're looking at is going to rise. So that's a question, we call it buying, but we are going in at a low price in the hope that the price is going to rise and we'll then make money on the change. On the other hand, in spread betting and also in CFD trading, a sell trade is simply a bet or a trade on a price chart that we're looking at and expecting it to fall. So that's when the price is high in our view, and we're going to make money as the price comes down. As you undertake some simulated trades, you very quickly get the idea of this. It's like a horse race, but there are some major differences. This race lasts for as long as we want it to go on, or until our horse is winning. Now, in 95, even 99% of all of the forex trading courses that I've seen, they don't tend to agree with that. What they do is place their trade during the course of a single day, and at the end of that day, close the trade. And they will close the trade whether or not it's making money. So if it's losing money, they will close it and accept the loss. As you'll see as we go forward with this, I don't do that. I'm quite happy to let the trade go on for almost as long as it needs to before I'm prepared to accept any loss on it. And I use a special hedging technique to allow that to take place. But that's getting very much ahead of ourselves. I think we're looking at module 3 or 4 before we get to that. Also, in the races we do it, if our horse starts to lose, we can decide when to stop it falling any further back in the field until it is ready to win. So again, a big difference. 99% of the forex trading courses out there would say if your horse, that's your bet, began to go back, you'll go to a point that you're no longer prepared to see that loss getting any larger, and you would close the trade down, end the race and accept the loss. We don't do that. We do get to a point that we have decided in advance we're not prepared to see the thing just drift on forever and lose more and more money, and we'll take some action to stop it getting any worse. In that way we give it time to come through and to get itself put right. But again, more of that later. We bet on a direction with an amount of money per pip, as we call it, of movement. A pip is simply a measure of tiny movements in an exchange rate. We'll revisit this later and get an exact definition. It's time to see how we actually open and close a trade. In front of you, you see a nice clean trading screen again with just the candlesticks shown for the pound dollar. There's actually been a big move this morning, and that was when the Bank of England announced what had happened in terms of voting for an interest rate change. Instead of the vote being at 9 votes against and 0 votes for, it was actually 2 for and 7 against, and that caused the market to move. That's why we can see that change there. But back to the subject in hand. So, in order to open or close a trade, we simply need to go to this area here, and you can see buy and sell. We've also got a volume indicator here, and it's very important that we make a decision about the volume of the trade before we open or close it. In this particular case, I'm going to change that volume, and I'm going to change it from 1 to 1.5. In a later module, you'll understand exactly what that is and how important it is. And I'm now actually going to make a sell trade. And I simply do that by clicking with the left-hand mouse button in this sell area. And because it's the first time I've done this on this particular simulated account, I've got to accept the terms and conditions. So click that, press OK, and away we go. It looks like it's going to make me repeat that. So there it is, it's in place. So you saw how instantly that occurred. And we can see the details of the trade here. We've got a trade reference number the fact that it's a sell and the volume, which is 1.5. We can also see at the bottom of the screen, in the tab called Trade, we've now got that number again, the time and date, the fact that it was a sell as opposed to a buy, the volume, the symbol we're trading, and the price that we're in at. And we can see the current price, and we can also see what profit or loss we're in with this trade. So, had I wished to make that a buy trade, and I'm going to put one in again now, I would simply have pressed, again after checking the volume, the buy button, and there it is. We've now got two trades in position, both at 1.5, and this one is a buy trade. You can see the time and the details of it, and you'll notice that both trades are in loss, and that's simply because of the spreads involved. If I wanted to close one of these trades, I could do so, and we've got a situation coming into play where one of them is coming into profit. So what I'm going to do is to double click on it, and a new dialog box opens up, and here it is. And in here I can simply close this trade as and when I wish to. I could also partly close it, so just for example close 0.5 of it or 1 of it. So I'm now in profit, and I'm going to close that trade. And there it is, gone. And as and when the buy trade goes into profit, I'll probably also close that one too. Now in the bottom area, the trade tab, the close trade has of course disappeared, and the balance has changed. We've now got a small profit shown in there. But if I go to the next tab along called Account History, I can see that we've actually got a record of the trade here. And that shows again the time that it was opened, the time that it was closed, the price for opening and closing, and the profit, which was a majestic £1.05. But that for the moment is as far as I want to take it on opening and closing trades. So now let's have a look at bid and ask prices. Strange terms and unique to trading, but here we go. You may have come across the terms bid and ask in respect of prices. Here I describe what they are and why they exist and how they act to pay the broker. Their presence is an alternative to paying commission. Hi again, we're going to talk now about bid and ask prices. And I've got a nice, straightforward, uncluttered trading screen here, just showing the pound-dollar candlesticks. And automatically you'll see that a line appears, and this is a price line. It is in fact the bid price. The bid price is simply the price at which we would be selling if we were to take on a trade. Why they call it the bid price is back in the annals of time. It would be much better just to straightforwardly call it the sell price. Now there's another price that we need to add in, and that's the ask price. So if we simply right-hand click anywhere in the main trading area and go down to Properties, left click, previously you've seen the colours and had a chance to change those. There's another tab here which is entitled Common. Left click on that, and there are various options here, including Show Ask Line. Left click to give it a tick, press OK, and the line appears, and it's in red. You can actually change that in the colour options. Now this line is the line that we would call the buy line. So it's the ask or the buy line. The difference between these two lines is normally 2 pips on this particular trading platform. On some trading platforms, that amount varies, depending on how much activity is going on in the market, and also, to an extent, the commercial instincts of the people behind the trading platform. Here, it's always 2. And this is where the trading platform brokers actually make their money. It's in that price difference. So if we're going to buy something, then we will always pay the ask price. That's the higher of the two prices. I've just changed the scale slightly by left-hand clicking and placing my cursor over the right-hand price column just to bring this two lines back into view. So, if we undertake a buy trade, we pay the higher price, and when we come to close that trade, it will be closed at the lower price. And similarly, if we undertake a sell trade, we would always be getting the lower of the two prices, and then when we come to get out of that trade, we'd get out at the higher of the two prices. So we can call them buy, sell, we can call them bid or ask. What you really need to know is that you're always worse off, and in this case always worse off by 2 pips. So if you're buying, you pay more. If you're selling, you get less for it. And that's how the spread, or the difference between them, the two prices, occurs, which is where the broker or the platform owner makes their money. We now know the controls. They're not as complicated as this jet, but they are definitely something that you need to understand. Imagine sitting in there and not knowing what control and what switch did what. It's exactly the same. You must get to understand how your trading system works, how your trading platform works, before you actually begin to use it. And hopefully that's the point that we've got to now, at least with a good rudimentary understanding.